Hello and welcome to the Aberthan Latham Investment Management video update. My name is Gregory Perdon and I serve as the bank's Co-Chief Investment Officer. My objective today is to share with you the Investment Committee's opinion on three asset classes. Firstly, the US equity market. Secondly, the US government bond market. And thirdly, the US dollar. Let's begin by looking at the economic backdrop. In the United States, we're seeing GDP growth of about 2.5%. We're seeing financial conditions which are conducive. We're also seeing business confidence at all-time highs. Subsequently, we're also seeing manufacturing and non-manufacturing measures coming in that are very supportive for this expansionary phase. From a tax cut perspective, it appears that over $60 billion will be handed back to corporates. That money can in turn be used for CapEx, for mergers and acquisitions, for share buybacks, and also potentially for dividends. All those actions will be supportive of the US markets. In terms of inflation, inflation is in control, moderate, and positive. If you look historically in context, when inflation is printing between 1 and 3%, US equity markets tend to do well. And finally, and for us one of the most important indicators, is the US unemployment rate, which is rock bottom at the minute. So, do we have the all clear? Not so fast. Equity valuations in the US equity markets are very high. In fact, they haven't been this high since the internet boom. And finally, investor sentiment is also at extreme levels, which is never a good sign. So do we like US equities? Yes, we're constructive on the asset class. However, we have a preference for European and Japanese equity markets. Why is that, you may ask? From a European perspective, we've witnessed the ECB, the European Central Bank, being extremely supportive of asset prices in the European economy over the course of the past few years. They've done that via bond buying and also ultra-low interest rates. If you support that further by the fact that youth unemployment has started to decline significantly, we believe that sets up the stage for a continued rally in European equities. And as we turn our attention to Japan, we believe that Abenomics is finally having a meaningful impact on the Japanese economy. Wages are beginning to rise. Inflation is starting to manifest itself. We're even starting to see significant private equity bids. All this lends itself to a conducive equity market for which we continue to allocate. So how are we positioned from an investment committee standpoint in client portfolios? We're currently underweight US equities, although we own them, and we're currently overweight Japanese and European equities. US government bonds. Everyone is well aware of the fact that the Federal Reserve is beginning to unwind their quantitative easing program, while simultaneously raising interest rates. So much so that some analysts are calling for there to be a big bear bond market. We're a little bit more constructive. The reason we're more constructive on the asset class is because we understand that unemployment and the ultra-low unemployment rate right now is so critical for the continued success of the US economy. Therefore, we don't believe the Federal Reserve will let there be any significant shocks to the US Treasury market. We're also more constructive on government bonds because government bonds serve as a hedge in client portfolios in the event of increased volatility. And finally, our views on the US dollar. What's clear to us is that there's a war raging in the foreign exchange markets as it relates to the value of the US dollar, considered to be the world's safe haven currency. On one side, the foreign exchange markets are not too keen on some of Trump's policies, like budget deficits, like trade wars, and finally, like geopolitical risks. On the more positive side, currencies that benefit from interest rate differentials tend to appreciate. And in light of the fact that we believe we're going to go through a modest tightening cycle in the US monetary policy, that in turn should support the value of the dollar going forward. perhaps later this year, if the Fed delivers on their promise to raise rates. In conclusion, we're currently underweight US equities and overweight Japanese and European equities. From a government bond market perspective, we're not forecasting there to be a bear market. And finally, from a US dollar perspective, although we recognize there's been weakness of late, we believe the dollar will appreciate longer term when the Fed delivers on their promises to raise rates. With that, thank you.